stoked about this one. I love talking about this topic, and I think all of you guys know that because you're all, by this point, really quite familiar with tokenomics. And today we're going to be talking about the Tokenomics Trilemma. This is the trade-offs. This describes the trade-offs between the three principles of tokenomics, and those are protocol utility, value capture, and economic security. And I want to go into a bit of how the process of coming up with these things and sort of what that was like for me. So I think a lot of you know this, but I was writing on eatsleepcrypto.com for that was probably 4 years before I started to write about tokenomics, maybe 3 or 4 years. And at the outset of that, I started to think about, how we can describe this system of designing and financially engineering value into a token. And through that, I wanted to getting more echo here. Terrible. Elon has completely ruined this app. Okay, so I wanted to go into a little bit of a background on how I came up with these principles and give you some insight into that. So starting around 2020, I was writing about what I called token engineering or token architecture or something. I might have used the word tokenomics, but in that process, I really wanted to find something that was a concise framework. And in consulting, there's this idea of MECE, M-E-C-E, mutually exclusive and completely exhaustive. So this is like my gold standard for anything that I'm creating and like any kind of framework that I'm building out. It's got to be mutually exclusive, so all of the things are distinct from one another, and the framework has to encompass all of the elements of that, whatever this discipline is. And in this case, it's tokenomics and the principles of demand-side tokenomics. So the Tokenomics Trilemma describes the trade-off between these three principles. And that's what I want to talk about today. And we're going to give some specific examples. I also want to remind you guys that this is an AMA. So if you guys have any questions, you can raise your hands or you can post them in the comments. I would like today to be a little more of a discussion. I've invited a lot of you because we're personally connected already, and I think you'd be able to just contribute to this discussion, whether that's in asking a question that you're genuinely curious about, or giving some insight into protocols that you've seen that have trade-offs in their tokenomics. So without further ado, I'll start by talking about the three principles. So describing these three principles, right? We've talked about these before, but the principles of tokenomics are protocol utility, value capture, and economic security. So the first one, protocol utility. This is what your protocol does for your users. And there are multiple groups of users, right? There's not just like one monolithic group of people that come to your app and do one thing. There's probably a bunch of different groups of users, and these are kind of like market segments, but they're also different types of participants in your protocol. So for example, we have in a borrowing and lending market, you have borrowers and lenders, and they are doing distinct things. So like on Aave, borrowers, people that want to borrow, they're going to borrow the USDC or Bitcoin or whatever it is. And then you have people that are supplying that as collateral. And those two people are interested in different things. The borrowers are going to be interested in whatever they're using the collateral for. But the lenders are purely what I call mercenary users. They're just there for the returns. They're usually not trying to do anything outside of get yields. Same with, in a lot of lending protocols, the people that are liquidating. So like the keepers of protocols, these people that are buying up the collateral in Aave in case it drops below the required loan to value ratio. So Aave works with an over collateralization system like most things in DeFi. And if your loan gets too far or too close to if your collateral gets too close to your loan value, then you can be liquidated. And in this case, the keepers as well are mercenary users. And this is a really important thing that I'm going to we're going to talk about later, but I want to give you guys a full view of protocol utility. So this is the first principle of tokenomics, and the reason it's the first is because you start with, what does our protocol do, and how do we create value? How do we provide value? So this distinction between creating value and capturing or accruing value is the next principle. So value capture, second principle of tokenomics. Value capture is a term used in venture capital. Peter Thiel popularized this in 0 to 1. The idea that he puts out is your business can be very valuable without actually accruing a lot of value to you. So you can have a business with a large annual revenue, but that business might not itself be very profitable. And all else equal, you should prefer to have a profitable monopoly. This is one of Thiel's conclusions and one of his main things. And so in 2021, I adapted this to tokenomics and wrote an article that you can find on Eat Sleep Crypto called Principles of Tokenomics, or Tokenomics 101 Value Capture. I think it's also republished on Token Dynamics right now. But so this concept, value capture, the idea is you've created a lot of value because your protocol has utility. Now you want to accrue some of that value to a token. And so when we're looking at these check boxes, or this short list of steps on how to design a valuable token, we're thinking first about what value are we providing to users, and then we're saying, what value are we able to capture from this value that we've created, and how do we do that? So the second principle of tokenomics is concerned with how we're accruing value to a token in a way that doesn't detract from the user experience and doesn't compromise the economic security of the protocol. And this is the third thing. And this is, that is the essence of some of the trade-offs we're going to be talking about today, is the trade-offs between value capture, the value you're capturing or accruing to your token, and the utility of your protocol. And then also the trade-offs between value capture and economic security, this third principle. So economic security is distinct from technical security in that technical security is the lack of bugs in the code. Economic security is the lack of bugs in the incentives. So your system needs to be designed so that the incentives of all participants are aligned, and that one group of participants can't act against another group of stakeholders, like the users of the protocol, in the case where somebody drains a DAO because they have a majority of the governance tokens, and that was officially allowed by the protocol, but maybe not a smart design choice, or they are acting, one group of users is earning on, at the expense of another group. So in a lending market, that might look like bad debt that's accruing to the lenders because of one borrower. So this would be Aave's bad debt problem in the Mango markets exploit that we saw last year, the lending market, or the lending feature of this perpetual market, was an example of an economic exploit. So if you guys want to remind me to give examples, I will do that, because I tend to get lost in the theory, but I want to be a lot more practical. And if you guys have any questions, again, just post them in the comments or raise your hand. So economic exploits, another example, the most famous example, and I think the most important example, was Terra. So everything in the Luna collapse was technically secure, but there were design flaws that were taken advantage of, which caused the protocol to collapse and lost many people, a collective billions of dollars, and took the whole industry down for a while. And I think the important thing to take away from Terra is that financial collapses can happen in DeFi too. And they can happen in infrastructure protocols with an Oracle network being taken advantage of, for example, or protocols that are dependent on these protocols with economic vulnerabilities are at risk because economic security is inherited. So an example of that would be like if you integrated, there was a recent exploit, and I'm forgetting the protocol, but somebody paid like $10 worth of Telor and staked it, in order to defraud the protocol that was depending on that oracle, and they made off with like $6 million or something. So that's an example of an economic exploit. And this concept of economic security is important because you might be designing the protocol and translating all of those requirements perfectly into the code. You know, you're not missing any semicolons anywhere, but the design itself might have perverse incentives. And so this is, you know, the third principle of tokenomics is economic security. And there are trade-offs, like we've talked about, with between protocol utility and value capture. There are trade-offs between value capture and economic security. And so in Terra, for example, there was a price dependency. So price dependencies are not necessarily bad, but they can compromise the security and integrity of your protocol if you introduce a token in the wrong way, in the wrong place, in conjunction with other mechanisms. And so Terra was an example of this, where the entire protocol was dependent on the Luna price. And it was dependent on the Luna to US dollar price. There might have been ways to do it. Mirror protocol was a synthetic asset protocol like Synthetics. If that had been more popular, it would have hedged against the volatility created by the Luna to USD pair, and the protocol might have been fine. So not all price dependencies are bad. There are ways to mitigate it. But this is an example of a trade-off between value capture and economic security. It would be a price dependency, as in Luna. So the you know, the more value that is accrued to the Luna token, the less secure, because of the greater the price dependency is in the protocol. So there's a direct trade-off there. The third point of trade-offs is between principle 3 and principle 1. It's between economic security and protocol utility. So the security of Bitcoin is directly at the cost of the user experience. So we talked about protocol utility as the value that you are providing for users. That trade-off is directly, directly affecting the the security of Bitcoin comes directly from the users, because the users have to pay fees. The more fees, the more security. The less fees, the less security. All else equal. There's a tail emission, and we can talk about all of the implications of the Bitcoin security model and the flaws there. But all of those can be boiled down to a trade-off in user experience, the group of users and their experience versus the security of the protocol. So this is an example of those trade-offs. So I wanted to give this high level with some examples. And I also mentioned I'd like this to be a discussion. So if you guys have questions, just post those in the comments or raise your hand and come up on stage. I'd love to discuss some of this stuff. But I want to get a sense of what people are interested in, and whether this is making sense so far. And if not, I'll just go into some more examples of different protocols. Not seeing anyone raising their hands for speaking. Getting a couple of hundred emojis. Cool. Okay. Well, I can keep talking about this. I would. Oh, we got one request. 2 requests. Cool. All right, I'm going to bring us up Brian first, and then I'll bring up Matt.
Nate, great overview, really clear, indicating like you're speaking this clearer than anybody I've ever heard. So thank you. Keep going. This is really good stuff.
Man, that's really great feedback. Thank you so much. Yeah, it's really That means a lot. I've been working on this for about 6 years, and these principles of tokenomics have come in the last 2 or 3. I started to talk about at the beginning, but I wrote an article. It's on Eat Sleep Crypto. It's called something like Token Engineering, Token Design, and Token Architecture in October 2020. And since then, I've been thinking about how to properly engineer value into a token. And I'll be talking about this in the next few weeks, but I'm just about ready to release a treatise on what I call price floors. So these are the minimum possible price for a token based on its use in a protocol, and how to calculate those and how to design them in. So that's really great feedback. Sounds like this is landing.
Are you basically saying, like, dependent upon the money velocity, you can have more emissions, and you're able to calculate that?
Yeah. So there's 3 types of tokens, or 3 types of tokenomic mechanisms, and you can model the value of currencies based on which mechanisms they use. And all mechanisms are going to loosely correspond to either an equity, a commodity, or a currency. Each of those have precedents for how to value them in traditional finance, and we can use those formulas based on first principles to value the minimum possible price of a token. And I've been doing this for the last couple of years, and there's a handful of tokens that tend to be close to their price floors. So those are really nice in bear markets to be trading in ranges. And so I'll be talking about not just how to use velocity of money and the equation of exchange to calculate the value of currencies, but maybe a bit about how to value equity-like tokens. And you're probably familiar, but traditional finance, you can do a discounted cash flows model. You can couple that and stack that valuation with other mechanisms to create kind of like a composite view of the minimum possible price of a token, because it's fairly simple to just add those together. You can assume that there will be, it kind of depends on the mechanism. I'm getting ahead of myself, but I will be talking about this in the next few weeks. But yes, velocity of money.
Hey, Nate, I'm really enjoying this so far. So my question for you is, it seems like we were implying that the Mirror protocol itself was actually pretty solid if it was built on like a legit, or like a stable coin that didn't blow up like UST. Like if UST was actually solid, the Mirror protocol actually may have worked out. Is that what you're implying there?
Yeah, so Anchor protocol, I'll give a background for everybody else. Anchor protocol was a way to get a almost hard-coded percentage of yields. The yields were subject to a DAO governance vote, but they were fixing that for a week or 2-week time period. But they, in that particular case, the DAO wasn't quick enough to react, and there were a handful of other issues that happened, with Terra's designs, Terra's economic security, their system design. But so Mirror protocol is a synthetic assets protocol, and you could create like ounce of gold, ounce of silver, barrel of oil kind of thing. So there were commodities that you could create. I think Mirror also had some price feeds for stocks. Synthetics doesn't. They're not allowed to, because their founder is doxxed and they're already on the CFTC's radar. So they can't create like Apple and Google and Tesla, even though there would be massive demand for people to trade those synthetic commodities or synthetic equities on a blockchain. But if there were a protocol like that, you could hedge the, if Mirror had been popular as Anchor, then the volatility would have been hedged across those assets into the base currency. This is like the foundation. Matt, you might remember the decentralized euro thesis. This is like my concept back in 2019, that you could have a variety of countries adopting the same currency, and it would form like a euro basically. And it would be like all the third world countries using the same currency. And so the volatility that comes from their political instability would be hedged against each other's. and would create the most stable currency in the third world. And I did a little model on that for newsletter subscribers. I have that somewhere, but yeah, it turned out that it was like, I don't know, 1.5% currency volatility, like daily or something like that, which is better than any of those countries separately. So I used South Sudan, Venezuela, Iran, and Zimbabwe, I think. But yeah, so you know, if you have the same underlying asset, it's kind of has a similar effect on the volatility of that asset and the price of that asset as having a basket of currencies like in an index, or a basket of commodities in an index. So mirror protocol, like overall, Terra was a really interesting idea, and I think this is like a very unpopular opinion, but Terra was a good idea. It just wasn't executed well, and it became lopsided. And I'm not saying that I think it can work in the future. I'm just saying that is, and you know, the concept of having the FAT protocol thesis in one ecosystem is like a very compelling, and eventually Ethereum might be that, you know, might be that thing. There is actually the very real risk that something similar to what happened in Terra happens in Ethereum, with ETH becoming dependent, a dependency, and there being overweighted price dependency on Ethereum for stablecoins. The same thing could happen. It's less likely because there's not just one stablecoin protocol, but you know, the Terra collapse was an example of an emergent problem. It was not necessarily because Anchor protocol, yes, it was like sponsored by Terra, but it was not it was not like integral to the protocol. Like Terra could have functioned without Anchor. It wouldn't have gotten as popular. But something similar could happen on Ethereum as well. So I went on a bit of a rant there, but to answer your question, yeah, you can hedge the volatility of an asset into an underlying collateral rather than trying to create a basket of those assets to create a stable index.
Hey, Nate, I don't know what you work on, but I'm gonna DM you. I definitely think we can work together on a couple of projects, and I do have to bounce to a call, but I just wanted to say thank you for putting this together, and I'm gonna listen to the recording later. Thank you. This is rad. Well done.
Awesome. Yeah, it was a pleasure. Thanks so much, Brian. Looking forward to it. So anyone else that has questions? Matt, did that answer your question?
Yeah, it did. I mean, I think maybe the big takeaway for me here, and I don't want to dominate the space by any means. I just real quick is just like, one is the nuance, being able to learn from things like from these experiments in Terra. And there were some red flags in that. I think they lied about the adoption in South Korea of China and everything, but there were some definite contributions from this whole Terra experiment, and a ton of pain to retail at the same time from it. So I'm glad you're able to like piece it apart.
Yeah, well, I really appreciate that feedback. And I think like Terra overall, terrible execution. Do Kwon is not you know, the kind of person that I think was capable of doing that. I'm not sure what kind of person is capable of doing such an innovative but challenging and demanding protocol. It is a monumental task to do what he tried to do. And they were, you know, defrauding people, and he didn't care, and so there were a lot of issues. But yeah, I appreciate that feedback. I mean, what I hope to be and become with token dynamics and you know, mainly token dynamics is a sort of decentralized regulatory agency or auditor. Like in crypto, we've already started to see some of these blue chip L2 beat. There are these you know, reputable people that are evaluating protocols, and they're alternatives to regulators. Like if we want to have a decentralized financial ecosystem, we need to have something like consumer reports. And so that's what I've been focused on lately, has been a lot of the economic security side of things. If you guys are interested, our GitHub is Tokenomics XYZ, and we have a repo on all of the economic exploits. So you can look through the past 6 years of DeFi and see what has happened before and what kind of design flaws have been made that were taken advantage of, that were entirely non-technical in their nature. Some of them were even no-code exploits. They were like just really low-hanging fruit for these hackers because they're system design flaws rather than technical flaws. So I have another request to speak. Pavlo, I'm going to bring you up here, and we'll mention again that the intended topic of this space is the tokenomics trilemma and the trade-offs between the 3 principles of tokenomics. So if you guys have questions about that or want me to clarify, just drop a comment on the space or raise your hand, and then I'll make sure to get to you. But Pavlo, bring you up here, and yeah, ask away.
Hey,
Hey, how you doing?
all good. I might have some issues with sound, but generally I got quick question. Like, there are 3 like features or bugs or anything. Like, how would you qualify impermanent loss, MEV sandwich attacks, and MEV just-in-time liquidity? So, do you consider it's like a compromise, or it's just like economic security flow, or it's like not related to this trilemma at all?
Yeah, that's a great question. I think MEV and solutions to MEV are a cope. I think MEV is fundamentally like a big failure, and I am not sure exactly what the solution is, but I think it's created a very large industry of not wanting to solve the problem directly. So I think MEV is a design flaw. It's not, it's not good. Like the MEV is good, actually. Like I don't think that meme is based in truth. And then impermanent loss, I think, is another. I wouldn't. That's less of an economic security consideration in my book. It's like I like the panoptic approach of like Uniswap providing liquidity on Uniswap v3 is selling options. That is a very good way to look at it, because it's like you're recognizing that you may incur some losses, but you're pricing the risk appropriately if you're calculating what range you want to provide liquidity in. Like that is the role of an options underwriter in traditional finance. And so I think it makes much more sense to think of it that way. And I love what Guillaume and the rest of the team are doing over at Panoptic, their options protocol in Uniswap v3. Super interesting. Highly recommend you check it out. So those are my thoughts on MEV. Yeah, I would categorize MEV as an economic security flaw. I think we might have tweeted about that earlier this week.
Okay.
And maybe I'll talk about why I think MEV is a design flaw. So again, economic exploits or economic security concerns are non-technical in nature, meaning that the code is followed perfectly, but there is still a way for one group of users to take advantage of another group of users. So MEV in this case would be the trade-off between the user's experience, so the protocol utility, principle 1, and economic security, principle 3. And so I will, if you guys go to my profile, you'll see my header has the principles of tokenomics, and there's a triangle there, and there's a triangle in token dynamics, and there's triangles and trilemmas and everything that we're working on, because this is how I have been able to conceptualize a lot of things. There are trade-offs between the protocol utility, the value capture, and the economic security of a protocol. And so MEV would be like the group of users that just wants to use Ethereum. They just want to use it. They don't want to get front run. And another group of users, which are miners, who are mercenary users, they're purely there for the yields, are able to take advantage of the initial group of users without any kind of technical exploit. It's just a system design flaw that enables this second group to take advantage of the first to the extent that that group is willing to pay it. So they're starting to call it maximally extractable or maximum extractable value. I think that's a good way to put it, because they will extract as much as they possibly can. And that trend will continue. Like, MEV is not going away. There are people that are, to be honest, much smarter than I am that are working on this. And I try not to even get nerd sniped by MEV, because I believe it's a band-aid. And, any solution would be a band-aid to a protocol that is otherwise fundamentally broken. And I don't know if we'll have MEV fixes for the next 5 or 10 years, unless Ethereum does some things with privacy and, bundles transactions automatically and makes them all private, and makes it extremely difficult for anyone to just front run by substituting their address or something like that. Again, I haven't thought too deeply about this, like most people in the MEV space have. But I would categorize MEV as a subset of economic security vulnerabilities.
Okay, I have like something to add on this one. Basically, there are toxic MEVs like what you're talking about, but there is also good MEV. For example, backrun, and there are projects that they're doing backrun transactions to do a cashback on swaps. So, for example, if I swap on Uniswap, I create a TaxDex arbitrage opportunity, and there are like RPCs that's doing a cashback by backrunning my transactions.
Yeah, but that's taking advantage of someone, right? Like, who's paying for that?
Basically, it's like no, it's just arbitrage that you create by every trade. Every trade create arbitrage, but you are getting more money back compared to just executing simple swap.
Yeah, but there's that money is coming from the the liquidity providers, or that what I'm trying to get at is it's not positive sum. So economic security is concerned with creating positive sum interactions for all groups of users. But I agree with you that there is there are some ways to cope with MEV, and protocols that are really smart. They're saying MEV aware protocols are solving some of these considerations for users by capturing some of that MEV themselves and distributing it back. So I think it's a nice, a nice temporary approach. Yeah. So I can keep talking about, and Pavlo, by the way, thank you for those questions and that contribution. I can keep sharing some examples of trade-offs in these principles, and if you guys have questions, just post those in the space or request the mic, and I will pull you up here on stage. So the canonical example of the trade-off between utility and value capture that I use, that I'm sure most of you guys have heard me rail against, is Uniswap. And it's nice, they're in the news right now. Uniswap is the best example of the trade-off between protocol utility and value capture, because they captured zero value initially and facilitated trillions of dollars in token swaps. So they have created massive value for this ecosystem, and yet they have failed to capture very much of that value at all. And now we're seeing a logical consequence of that, which is they have to capture value outside of the protocol because they didn't capture value in it. So Uniswap Labs is getting the revenues from these trading fees by inserting not only are they doing the KYC, AML, going full compliance, but they are capturing value at the front end and driving users to decentralized front ends like 1inch, or well, not necessarily decentralized front ends, but protocols that are not using their centralized front ends. So 1inch is going to become more popular because of this Uniswap fee at the front end. And most importantly, in my mind, uni token holders are not going to see the revenues from these fees. And so this is because of this trade-off of utility and value capture. Uniswap optimized for utility, protocol utility, by providing a lot of value and economic security, because they don't have any price dependencies. The token doesn't change the protocol. They have a hyperstructure, an immortal protocol. They can't change their the versions after they've been issued. So like V1, V2, V3, V4 will always exist in their current form for people to use, but they have not captured any value. So they have the first and third principle of economic security, protocol utility, or first and third principle of tokenomics, protocol utility and economic security. But they're missing value capture, and they optimized to build something that was essentially a public good, right? This is something that Nate Suits from the Token Engineering Commons and I will talk about in the next couple weeks on one of these spaces. But you know, public goods in my mind are do not capture value. I think he has a different definition, and I would defer to his definition. But I think a lot of people understand public goods as there being no profit opportunity for investors in the protocol, and that includes developers, you know, stakeholders broadly. So that includes developers, that includes VCs, that includes the users who are investing in that protocol. Uniswap issued a token, but did not capture value to that token. So you might be asking, well, what makes the Uniswap token valuable, and why is it $6? The answer is speculation. People are uninformed. They think that the Uniswap token might be valuable someday, although I would be willing to bet that confidence is waning. And the venture capital investors in Uniswap don't want to sell because they would tank the entire market. So Uniswap created this worthless governance token, and you know, I don't know how controversial this is. The idea that governance tokens are worthless because people are not going to want to pay to vote in your protocol. If you're not accruing value to a token, it's not a valuable token. Like, people don't, you wouldn't, even if you went to McDonald's every day, you wouldn't pay to change their menu. You probably wouldn't even fill out a little form that said that you want a hamburger with like extra pickles or whatever. It'd be the standard. So that's, you know, this concept of like Uniswap solving for the utility of the protocol, creating a lot of value, and being secure because they're a hyperstructure. They don't have token dependencies. So there's, you know, there's not a lot of economic exploits or economic vulnerabilities available there. They have solved for two of the principles of tokenomics at the expense of the second, which is value capture. So the second, I gave you guys the example of Terra being a protocol that had utility and value capture, but not economic security. So the trade-off here comes from this idea that the more value you capture, all else equal, the more likely you are to have an economic vulnerability, because the tokenomic mechanisms that capture the most value tend to create price dependencies or create you know, demand in the protocol that can be taken advantage of. There's a, you know, I'm not remembering exactly how I want to put this, but I wrote about tokenomic leverage back in 2021 or 2022. There's an article on Eat Sleep Crypto. You can check that out. It measures the amount of value that is flowing through a protocol proportional to the amount of value that that protocol is creating. And if your tokenomic leverage is above 1, then that's a fairly good sign that you have a price dependency in your protocol. And it's important to check for economic security vulnerabilities. So I mentioned Terra is an example of a protocol that solved for the first 2 principles of tokenomics at the exclusion of the third. So protocol utility, Terra is creating a lot of value by having a large ecosystem, or was creating a lot of value by having a large ecosystem of complex products that you could use, like Mirror Protocol, like Anchor, like some of the other things that you were able to do in Terra that were basically copycats of the Ethereum ecosystem. And it had value capture because it was using Luna for everything. That was the idea of Terra, was like, what if we used the same coin for all of our things and then just made a ton of money because all of those things get used, and the token is just a catch-all for the value. It's a a catch-all for the value capture and the value accrual. All the value in the ecosystem is accrued to one coin. That creates a lot of token price dependencies. And I mentioned that these are not necessarily bad, but the way that it happened in Terra was dangerous and led to the collapse. So this is an example of a protocol that solved for the first 2 and not the third principle. A protocol that has economic security and value capture, but little utility, would be like I would say like a small cap utility token. So I mentioned protocol utility is the value that you're creating for users. That can be measured. The total addressable market of your protocol is like the market size, the size, the quantifiable size of the amount users are willing to pay, or like the size of the problem that you're solving. So it stands to reason, if you're solving a small problem, then you're not creating you're not creating a lot of value for a lot of users. And so in this sense, the one way to have value capture and economic security would be to be used as a medium of exchange in a niche protocol that's for like verifiable computing on a blockchain for like DeSci data or something like that, or having like very narrow qualities, because there's a specific protocol that I have in mind that I won't name, but it is used for verifiable compute and which is like deterministic and empirically provable on chain. But the target market for this is like scientists that need to have the most rigorous vetted studies that are also willing to pay like 10 times the amount to have this be executed in a trustless environment. And so while there might be a couple $2 billion a year in demand for those kinds of things, there is not a very large target market. And if you're only capturing a fraction of that, then there's not going to be a lot of value capture either. So like value capture, the second principle, builds on the first to protocol utility. The more protocol utility you have, the more value capture as a not as a percentage, but as a fixed number, or I don't know what the word I'm looking for is, but the more value capture you're able to get. So we have another request here, monologuing for a bit, but Octopus is coming up. And if any of you other guys have questions, I see there's one comment. I'm going to check right now. But just post those underneath the space. We are coming up on close to the time that I've allotted for this. And if you guys have any more questions, just drop them underneath the underneath the space here on Twitter, or send me a DM if we don't get to it. Yeah, Octopus, go for it.
I would echo the earlier comments about the clarity and the quality of the information given. So I really appreciate the effort you put into this and the transparency you publicize it with. My question is, I heard you say a couple of times about different, about Terra specifically, that maybe it could have worked under different circumstances. Are there any design structures that you would point to and say, like, that's been tried and it failed and it's hopeless? It's just so lacking in one of these areas that it should not be tried again?
Yeah, that's a great question. Like, are there any things in crypto that don't work, or like that just will not work? Is that basically your question?
Yeah, basically. I mean, you have a very vast knowledge of failures, and I'm wondering if there are any kind of object lessons where you can look at a structure and say, this has no economic security and it's never going to work, or
Yeah.
something equivalent.
Yeah, great question. So I would say undiversified endogenous collateral. So like anytime you see a stable coin, it was hilarious. We just had one of these this week. I think it was USDR or USDM or something like that. They used their own token to collateralize their protocol. They also had real world assets, which I'll get to in a sec. But like they got exploited for the smallest economic security exploit I think I've ever seen. It was like 200,000 or something that completely tanked the protocol, because people are quick to realize that this architecture is not safe for a stable coin. Blue Chip put out a report. Bluechip.org is a really great resource on stable coins. I think they do great work, and they have a rating system for stable coins, and they mentioned, hey, had this come on our radar, like it was a very small cap stable, but if we had seen this, we would have said this gets an F immediately because of their use of endogenous collateral. So they used their own governance token to collateralize their reserves, and that is an instant red flag. There's and I said undiversified because if there were, let's say that governance token is also used in a lot of other ways, that would be diversifying the use of the token, similar to this decentralized euro concept I mentioned earlier, where you can have an emergent stability in one asset because it's used in many places. The inverse of that sort of is like an index, where an index is getting its value from many assets. This would be one asset being used for many things. Both of those can give you financial stability in a protocol. And so it's not that use of exogenous collateral is necessarily bad, but undiversified use of exogenous collateral in a stablecoin protocol is very dangerous. I will probably, if you guys are going to be in Istanbul, I'm slated to speak about this at Unstable Summit, and would be happy to elaborate more in the back channels if you guys are interested. That would help me flesh out my talk as well. Second red flag that I see in crypto is the emphasis on a virtuous cycle of some sort. I tried to communicate this a while ago with like a graphic of arrows that are, like arrows that are in a circle that indicate that kind of virtuous cycle. I said, if you see this in someone's pitch deck, run. Because when people are emphasizing that their protocol depends on a virtuous cycle, you have to ask, what happens if one of these things changes? If one of the, what happens if the arrow reverses? And that was the case for Terra. There have been other protocols that have depended on virtuous cycles that are smaller, but in general, when people say the more X, the more Y, the more Z, the more X. Like that is a circular recursive dependency, and is an immediate red flag, because it shows that they're completely dependent on that cycle continuing, and growth is not infinite. So that would be a second red flag. And then in terms of a concrete thing, another protocol that just won't work. I mentioned real world assets. I think there are ways for things like real world assets to work, but they won't be fungible. You can't bridge the Oracle problem in a well, I won't say can't. I actually think it's possible to make stuff like that work, but it requires very complex crypto economic schemes and secure oracles, and there are a lot of edge cases with the ways that RWAs are trying to be. People are trying to implement RWAs right now. So that would be like one thing that I'm like, yep, that's just not going to work. Like RWAs in DeFi this cycle is not going to work, because people are not they're not thinking about it in the right way. There will probably be a handful of collapses like there was with this stablecoin that I mentioned, which was also half backed by RWAs. And the final thing that I'll say is maybe an answer, it comes to a lot of people's minds that people try every time, is token curated registries, TCRs. I actually think TCRs can work unironically, and that they just have to be implemented in the correct way for a niche. And also there's some elements of diversification, similar to the stablecoin idea, that have to be incorporated to TCRs, token curated registries. So those are all the things that come to mind when you ask about what definitely won't work.
That's really helpful. Thank you for the answer.
Thank you for the question. Yeah, we have one more request. Yusuf, I'm going to pull you up on stage here, and then we will close this space out. How you doing, man? Hey, Yusuf, you're up on stage now. You go for it.
GM Tokenomics. So
GM.
yeah, my okay. First of all, I would like to maybe ask a question on the recent topic you raised. That's the RWA. So my thinking is, I don't know, maybe perhaps someday you will have to find maybe a session to host, and where we can discuss that extensively, because it's something I was actually interested in. But then sometimes I do tend to think about the possibilities of it working and then the possibility of it not working, because the hype of it of RWA in terms of let's say more of what we're looking at more as a security token, looking at real estate, and then maybe perhaps someday we'll actually discuss on that. Then the other one is, I want to just maybe if you can just check out there's a project, I don't know, it's a protocol. I think it's on Polygon blockchain. It's more of like, I want to just maybe if you can analyze the way, because there is not actually, I don't think there's actually a utility attached to that coin. It's called NWNT. What it does basically, it's more like a protocol that has routers, and then maybe so each router serves as a micro node where their clients that connect to the host. So just the way we use our normal internet. So they get to use, as they keep on using the internet, they keep on mining that token. So the host, it depending on the number of clients that connect to that host, which is like routers in different places, and maybe every individual can own a router, and then he gets paid, or he gets a token, or he gets paid in that token, or he gets rewarded with the tokens. But then the issue where I see is that because that token is not being, most times anybody that gets rewarded tend to just sell it off. So there is no really any, should I say, any transfer or any transfer of flow of that token. So that's why so I'm just thinking of, is there any way okay, to me, I thought of, okay, maybe perhaps let's assume let's say a platform whereby people can actually use that token to actually like do an e-commerce whereby, okay, like I buy more of like an exchange that will actually like keep the value a little bit stable, kind of, than just, because most times when it's mined, it's just sold out and maybe like swapped with maybe like ETH or USDT. So there's always okay, though they have this staking, they have this staking, or this staking platform whereby you have to stake before you can actually even own the router. But then I don't think that's enough to actually keep the value of that token. So I don't know, maybe if it's something that we should, maybe like you can just maybe give an idea of how it goes. Thank you.
Yeah, great. That's a great question. I think there are a lot of protocols, and they primarily think about many protocols think about their token as a way to incentivize a certain behavior, and they forget to think about what makes the token valuable and what makes users actually want that token. So they're thinking about, we want users to do, something. We want users to post on our social media app, or we want users to like host our network with a micro node, right? But they're not thinking about like what is the like why do they want to do that thing, and if they're motivated purely because of the token. Like some users just want to volunteer and help, or some GameFi gamers just want to play fun games. So users are not necessarily always financially motivated. This is another mistake that protocols make, is assuming that you can pay people and have their incentives align in that way. But many users are not interested in the financial returns of a protocol. Some are interested in what the protocol provides them. So for example, in the NIM network, another network of nodes, users are using a mixed net because they want privacy. Giving away tokens to random yield farmers, or giving away tokens to try to incentivize users of a network that is providing a fundamentally very valuable service that can only be done on a blockchain is misguided, because you're mistaking the incentives of those users. Similarly, when you're trying to pay users to use your token or to use your chain, you have to consider what their incentives are to use that token or to hold that token. And if there's no reason that they need to hold that token, then the token price is going to go to zero. It's going to go It's going to go towards zero, because no token price ever goes to zero. It's very rare, but token prices will approach zero, and there's no end to the number of decimals at the end of a 99.999% drop. It just keeps going lower, so you can always go lower, unless there is a price floor, right? Unless there is a reason that the users are going to buy the token. The best reason is going to be if the token is required to use your protocol. So you're aligning the desires of users to use whatever the service is your protocol provides, the protocol utility, and you are causing them to purchase the token, which is going to accrue value to the token. That's principle 2. And you're doing all of this in a way that is aligned. So there is economic security because all of the groups of users in your protocol have aligned interests, that you've looked at the system design holistically and said, here is how every user benefits from this system in ways that don't hurt the interests of other users. That vetting of your protocol's system design is the economic security of the system. So to answer your question in short, before we wrap it up here, the way I would go about that, yes, staking is not a sufficient demand driver. That's just a way to reduce supply. And if the token is just used to get more of itself, then that is a circular dependency there. Not quite the same as the circular dependency in Terra, but similar. Terra just had that with extra steps. So I would reorient the network so that it uses the token and then ask what are the user's motivations and map those to their behavior in the protocol, rather than just assuming that everybody wants to be rewarded with tokens. If everybody's just there for yields, you don't have a valuable product. Your token, your protocol has no utility, and so it's failed the first principle of tokenomics. But it sounds like this is a fundamentally interesting, valuable network, and I have some concerns about the potentially trusted hardware, or the Oracle concerns of the elements of, there may be real world data that needs to be on chain. That's a consideration. But overall, I would say the network needs to focus on the token, and it needs to focus on how to accrue value to that token based on what its users actually want, based on their incentives. So I hope that was sufficient explanation for you, and I appreciate your question. Appreciate everybody who came out today to listen to me talk about these trade-offs. And if you have any more questions, just send me a message and tune in next week. I'll be talking about more of these types of things. Might be talking about price floors. Mentioned that earlier, and teased that article a bit. So stay tuned, and looking forward to talking with all of you and seeing you next week. Thanks so much, everybody. Catch